start so far for 2023. Mayuresh, what do you make of the market? It's just stuck in a range, not going anywhere.
Afternoon, Nikunj. So if you probably track and analyze the O'Neill methodology like we do at our end, obviously we're waiting for a follow-through day, which is a 1.5% move on the index, either the Nifty or the Sensex with substantially heavy volumes. If that happens, the substantiation in terms of the market move sustaining going forward can probably persist. Having said that, the pockets of strength where certain sectors are still holding out, I think those are the pockets where the earnings will be viewed with a very keen eye. So capital goods stroke infrastructure keenly watched out for. Second, what kind of allocations probably come through for defense stroke road players, that is EPC players as well, and energy as a theme as well. So to that extent, I think financials which have largely outperformed the market are showing sideways consolidation at this point of time. Some profit can also be seen in the PSU space. So this space also should do well selectively. But again, I think it's these three large spaces where earnings can probably hold up. So again, waiting for a follow-through day and expecting some positive announcements for a few key sectors which can be trigger points in the budget to come.
Markets fearing about a change in long-term taxation structure. Is that a fear? Is that making markets nervous and nothing happens in budget? Could it lead to a spike up?
That's one aspect, Nikunj, that the markets are probably keenly apprehensive about at this point of time. But I think it's every budget that we probably speak about this. And a large element is what might happen this time around as well. Is there a tweak in the tax slab itself or the duration itself? My own sense is that there might be some tweak happening on the duration front. Therefore, the markets will take that into its stride. But the other element that the markets are also watching out for in the budget, because this is one last budget, the last full budget before the general elections happen in the next calendar year, is not too many schemes which are social in nature. So I think the growth aspect and the allocations towards growth is something that the street would ideally watch out for. So I think these two aspects is something that is clearly creating apprehension. But I think once they are settled and taken care of, the event will largely be behind us, and markets will revert back to looking at earnings growth in key sectors where either announcements are made or earnings remain strong, as I said, looking at global and local macros as well.
Mayuresh, a stock like Nykaa, which was worshipped by everybody, including best of the fund managers, has plunged to a fresh 52-week low. Zomato is not at a fresh 52-week low. Paytm is not at a fresh 52-week low. Policy Bazaar is not at a fresh 52-week low. But the strongest of the lot, Nykaa, is plunging every day. What has changed in terms of an opinion for Nykaa?
So that the change of opinion has happened a few months back, Nikunj, when the selling has started coming off. I think as Amit mentioned, the valuations were just not sustainable at those levels. And the expectations in terms of earnings delivery, which was obviously expected to be on a very heavy base of last year, was just not sustainable. So as earnings are expected to come through, and as they are coming through in the past 2 quarters, expected to end this fiscal as well on a reasonable pace, if I would call it, I think the bottom line growth ultimately is not growing at a pace at which the valuations were probably there a few months back. So I think the de-rating which is probably happening onto these stocks is a pure mix in terms of more sustainable valuations in terms of the earnings outlook going forward. And obviously the supply side pressures that we've been witnessing in all these new age platform fintech companies as well. So I think both these factors are at play when it probably comes to Nykaa. I think we'll wait and watch. We want to see sustainable earnings growth, which is compounding, which probably does not seem to be the case with most of the new age stroke fintech companies.
So let's say if somebody is long fintech, is it too late to sell or you can still sell and get out?
No, so I think the ideal way to put it the other way around, Nikunj, is to still wait out. So hearing out statements from a few companies like Paytm as an example that we might turn profitable in the September quarter in this fiscal. I think let the numbers do the talking. If the compounding is happening consistently over a couple of quarters, I think the re-rating will come automatically. The markets will recognize that. And even if we are late in that move, even if the stock moves 10, 15, 20% on these factors probably playing out, I think it's perfectly fine because I think you're having the shorting in terms of some elements of fundamentals supporting the stock going forward as well.
Mayuresh, your take as far as these consumption basket is concerned. Asian Paints, HUL, what's your expectation? What are you penciling in?
Afternoon, Anisha. No, if you probably look at these commodity consumers, I think the inflationary aspect which hit their margins for the past few quarters, that will start ebbing off from this quarter. Yes, the hit will still be there because of the high cost inventory that they're carrying on their books. But I think it's a dual effect when it comes to these consumption players. A, how is the demand recovery happening in terms of volumes? And B, the margin recovery itself, which creates a huge amount of operating leverage. Now, the expectation largely is that since rural India is expected to pick up from Q4 and significantly from Q1, you've seen a very good Rabi harvest happening at this point of time. Expectations of good government support happening through in terms of MSP increases, both in terms of budgetary announcements and otherwise. I think that should hold up the rural economy and ensure that the recovery probably happens over the next 2 quarters. Having said that, a stock like HUL, we obviously like leadership stocks. If it comes and crosses its key pivot level of 27.20, 27.30, I think the expectations from Q4, specifically in its key segment, the personal segment, as well as expectations in terms of home care, hair care, and food and confectioneries as well. The EBIT margin pickup should be quite significant going forward as well. The strategy that they're probably deploying at this point of time, many Indias in India has different SKUs for rural, semi-urban, and urban India. And the urban market's holding out pretty strongly even at this point of time, in spite of inflationary concerns, should bode well for the stock. Asian Paints, a large element in terms of how volumes play out, seems to be a good structural case that they should show significant improvement going forward as well. Input costs, as your colleague rightly pointed out, coming off means the restocking which happens ensures margins expand from the coming few quarters. But valuations are a tad bit too high even at this point of time. Obviously, a leadership stock within the segment that they operate out of. But between the two, again, HUL probably looks a tad bit better placed.
It is metals, 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 metals all the way. Mayuresh, we had a discussion in the morning where the opinion on metal was split right in the middle. Those who believe recession is around the corner, they think metals is a good short. Those who feel China is opening up, metal is a good long. What is your view? Long, short? You can't use sideways that I'm watching out, can't say all this.
No, obviously not. So the momentum probably continues with the metal stocks. Two things happening, I think. One, as you rightly pointed out, Nikunj, I think the China trade, unlocked trade, largely known to the markets at this point of time. So I think the bottoming out in terms of both ferrous as well as non-ferrous prices seems to be the best case scenario at this point of time. As China opens up and as restocking starts taking place, you've already seen iron ore prices inch around $125 a ton. You've seen China HRC prices from their lows of $520 a ton come back to around $625 a ton. Pellet prices have shown significant increase and so have coking coal. So I think to answer your question, I think inventory levels are extremely low at this point of time. Any restocking that happens in China and globally as they start producing again, being the world's biggest producer, should show a significant impact in terms of LME prices as well. Base prices also, specifically aluminium and copper, in terms of the usage for electric vehicles, batteries, aluminium bodies as well, should hold up as well. Those prices have also hit an all-time low at this point of time. So I think the entire perspective is prices should start inching up significantly as we pass through into Q4 and go ahead from there, even as we enter into the next fiscal as well. So yeah, I think the momentum trade should continue with the